really what we're able to do is help investors actually achieve double-digit returns in much less of a time hold than the traditional options that they have available, whether it be active or passive strategies.
Welcome to Alt Investing Made Easy, where we explore the complex world of alternative assets. I'm Roland, a securities attorney, investment advisor, and your co-host.
And I'm Sarah, an investment advisor and corporate attorney, and your other co-host. We'll guide you through real estate, private equity, and more, making complex topics accessible.
Tune in for insights that empower your financial journey.
Let's make alt investing easy, one episode at a time. Hello, everyone. Welcome to Alt Investing Made Easy. Today, we have a new friend with us, Mitch Flax. He's the founder of Net Equity Capital. And the key takeaway we want you to take from this episode is a concept that we really want to keep emphasizing on AIM, and that is our discussion about how wealth management professionals think about investing in alternative assets. And Mitch is here as one of those experts. Also, we will talk about investment management metrics and what the CAIA designation is for, which is something that Mitch can tell us about and why it's useful. Mitch, welcome.
Thank you for having me.
Yeah, and I'm really excited to be here today with you, Mitch. To be transparent, we met through LinkedIn, had coffee, and had a really good conversation, and agreed to continue this conversation here on AIM. I'd like to preface this by describing how what we really want to do is make technical concepts simple. Talking about investing can be really taxing on the intellect, but one of the things that most struck me about my conversation with Mitch initially was his advice about how to become a better investor and make better investment decisions. If you're looking to make an allocation to the alternative asset portion of your investment portfolio as an investment advisor, we can say that Mitch's opportunities that he has could be an appropriate investment, taking into account your specific financial circumstances. But as always, this doesn't constitute legal advice, and this webcast alone doesn't initiate an attorney-client relationship or an investment advisory relationship. So in order for us to make recommendations specifically to clients, we have to have that relationship in place. But Mitch, I need to stop talking and let you share with us a little bit about your background, including where you grew up and where you went to school.
Sure. Yeah. So I guess I'll start chronologically and where I grew up, just outside of Boston in a town called Newton, Mass, and ultimately ended up down south in Florida. As an 18-year-old, we have different metrics of what's important to us. And at that point, it was the beach and anything that resembled better weather than the harsh New England winters. So I ended up playing rugby down at the Florida Atlantic University. We actually just made the Final Four several years ago in college hoops. So go Owls, very excited about that. But I got my start in the investment world as a junior, where I got licensed for my Series 7. I couldn't pass any other class, but for some reason, passing the Series 7 meant a lot to me. And so I cut my teeth studying for the Series 7 and really entering the investment business at a very young age. But it was all sales and marketing, probably not too much around any type of analysis or due diligence work. But I've been involved in the financial services industry for the last 20 years, since I've been registered in 2003. Most of that has spent catering to wealth managers. They call us wholesalers, so representing mutual fund asset managers. Most of my last 10 years have been spent with MassMutual in the pension plan and defined contribution space. So helping advisors and their clients maintain, establish, grow retirement plans, making them more efficient.
That's really important. And I think it's interesting that you got interested in something like a Series 7 or the investment space when you were young, because I do think probably happens a lot, oftentimes with our clients, at least, who are starting to work on promoting alternative investments or investing in them, that, you know, they come to it as almost like a second career after having worked as an engineer or something else and realizing, oh, well, need to do a bit more than that to have the financial success that I'm seeking. So that's really cool that you've been able to see industries go through a lot of cycles when you've been in the industry for so long.
Well, Mitch, maybe tell us a little bit about net equity capital. When we were talking last week to prepare for the call, you said that you're an advisor to advisors.
Yeah. So at Net Equity, my business has really gone through several iterations. Originally, when I started Net Equity, my goal was to actually deliver alpha. And as private investments have really become democratized, it was something that really stood out to me as something I wanted to explore. I looked at, the public investment space as something of the lines of maybe overpriced or expensive beta. A lot of that was commoditized. I found it very difficult for managers to continually outperform the market. So on the public side, probably a bit of an indexer now after representing asset managers and selling on performance. So not sure that's my mantra and my thesis in most specific asset classes, but I'm willing to have a debate and explore that. But ultimately, I wanted to go off on my own, and I think first and foremost, it was a quality of life that really initiated the birth of Net Equity Capital, and so. Really at the intersection of my experience working at Mass Mutual, delivering retirement plans through financial advisors, and being able to really try and figure out where my space in net equity is and in the investment world. I ended up at the intersection of tax deferral and real estate. And real estate has been a passion of mine for quite some time. It was something where, just like anybody else riding a free interest rate wave, I was able to get involved and earn some solid returns. It certainly has become a lot more challenging lately, but I tried to figure out how I would really deliver alpha to my investor base and that natural network of wealth managers. And so what Net Equity is today is really a culmination of all my experiences. And really what we're doing is we're taking 1031 money and we're providing a unique strategy utilizing that structure to facilitate short-term bridge finance for real estate developers. And so really what we're able to do is help investors actually achieve double-digit returns in much less of a time hold than the traditional options that they have available, whether it be active or passive strategies like Delaware statutory trusts.
That is, it seems like it's so important because a lot of people are talking to us about 1031, whether they have 1031 money that they need to deploy or what some alternatives are to use such money. It's really interesting, and it's nice to hear that you have something that's targeted at that shorter hold time period. So that's really fascinating. I don't know if we had discussed that before. So make sure that we emphasize that for our audience, that this is another approach to addressing 1031 money.
Yeah, maybe just as a little exclamation point or a reminder that for a 1031 exchange, you can't roll the proceeds from the sale of real estate into securities. You have to roll it into what qualifies as like-kind property and securities, and investment in the private securities deals that Sarah and I work on. Aren't eligible for 1031 money unless we structure it, as a tick. And but yeah, that's a great thing to be aware of, Mitch. And for sure, we want to keep you on the radar for all the clients of ours that talk about needing solutions for 1031 exchanges.
Mm-hmm. Yeah.
When I explored the alternative investment space, I really thought that I would get into much more interesting and, I guess, investments that had a bit more sizzle than 1031. But here I am. And as they say, the riches are in the niches. But it was sure a lot cooler looking at, a lot of these venture capital and private equity direct investment opportunities. But here we are.
In the end, it's about actually getting something for your money, right? So that's good. Okay, well, moving on, I think we were going to talk about the CAIA designation a little bit. And you had mentioned, and we're not so much wanting to know about how you go about getting that, but more what it means and what it's meant for you, and also what it is, right?
Yeah, it's a great question. When I first embarked on this journey as being a first-time founder, especially in the investment world and trying to find my place, I started syndicating private equity real estate deals that I did myself personally from a passive perspective. Also very active as well. But as I was starting to syndicate, I started to ask myself questions. Where's your experience in doing the due diligence of syndicating these real estate deals? And, there is certain business and investment acumen that I inherently have built up over the 20-year investment career. And, perhaps not being a novice, but definitely I think 20 years of experience, you kind of know what looks good and what doesn't. But there was really no formal training for me to really establish any type of due diligence framework. And so the very question I had to myself is, if I were to do business with somebody like me, what designation or experience would I want them to have? So it was a great time to look in the mirror and explore the designations. And several friends had recommended the CAIA designation, or the CAIA. We call it CAIA just because it's easier and it rolls off the tongue. But CAIA has really been the cornerstone, the foundation of my entire practice. And so embarking on that journey for, a 42-year-old was really a challenge for me. And, getting familiar with my calculator, and not the traditional calculators, but I've got this right here, my BA2 plus.
Gosh, it looks intimidating.
Yeah, and so it's really provided that framework for me to really understand what good due diligence looks like. And even so, it's not going to, give you this incredible due diligence framework, but it's going to provide a good foundation. And there's no substitute for experience, because at the end of the day, you've got to ask great questions. But it's certainly, a big part of my identity in the investment space. And I love the organization. I love how we promote that continual professional development. And if you're not going to embark on the 2-level journey, which I say, if I could get the designation, I think anybody with a brain cell could get the designation. But I didn't do anything else. My job in that time period was to pass the designation. So there was 250 hours of, allocated time per level. I probably did more of that just because, me being 42 and somebody who needs to continually focus on this sort of analysis and a lot of formulas. It was a monumental challenge, and I'm very happy that's behind me. But at the end of the day, yeah, it's really made me a much better investor for myself and for other people that I work with and my clients.
We're really glad to get to hear about it because I know Roland holds that designation as one of the few that he finds really important and meaningful in this space, let's say. So, if it's all right with you, we'll put a link when we publish this episode that leads to the organization if anybody is interested in finding out more about pursuing that designation. It sounds like it's something that some people that we know might be with some of our audience, or other people that we know as clients might already be pursuing or might be interested to pursue. So,
yeah, and ultimately, I will say, other than the CAIA designation, which is 2 levels, there are other programs like Unify. There's a fundamentals of an alternatives investment certificate. There's a private debt micro credential, digital assets, real estate, private equity micro credentials. So if somebody doesn't want to embark on that journey and actually has a life and they enjoy the things that they do, because I was not able to do those things while I was studying for the CAIA, but there are other micro credentials, and anybody involved in the space, specifically wealth managers or any high net worth investor that wants to sharpen the knife, as they say, I think, there's plenty of educational resources that CAIA.org have on the website.
Excellent. So it's CAIA.org. Great. That's really useful information, and also knowing that there's smaller steps that you can take depending on what time you have to commit. So that's great.
And you play a role with a local chapter too, right, Mitch?
Yeah, I got involved. Personally, it was just kind of this interesting stroke, but I was the former president or exiting president chairman, Bill Kelly, actually grew up in my hometown. Well, not grew up, but lives in my hometown where I grew up in Newton, Mass. So we had that connectivity and early on, and I really wanted to have a better local community. And so I joined the Central Texas CAIA chapter as one of the executives, and really just try and promote the CAIA mission, and ultimately just have a better community of really smart people here in Austin. We've got a lot of great allocators because we've got a lot of fantastic pension plans here. And so there's a lot of smart folks who have incredible experience in due diligence in the overall private market. So why not foster a community? And I get to selfishly be a fly on the wall and listen to smart people chat. So
it's the best education.
I agree.
Well, now that we're talking about CAIA, maybe we get into some details about, those very metrics that you consider, and move on to talking about some of the quantitative metrics that you might use for wealth management.
Yeah, I think, are you talking specifically about some of the metrics that you use to evaluate potential returns? Is that what we're focusing on?
Roland,
Yeah, for sure. I mean, we never want to misrepresent what we are. I'm a registered investment advisor, and Sarah and I work together with an investment advisor, but I don't want to misrepresent myself as being this sophisticated portfolio manager or I just, I'm not the person that is really, I think it's somebody like you that would be able to speak to what kind of metrics you look at when you're evaluating a private investment deal. And there are a couple, and we talked about them, like internal rate of return, and then there's return on investment, and we talked about the Sharpe ratio, but just none of these by themselves really encapsulate whether an investment is good or bad, but they are used in the industry. And it would just be interesting to hear how you think about these investment metrics when you're evaluating any kind of investment, really. But I guess it sounds like commercial real estate is a big part of your practice.
Yeah, it certainly is. And IRR, yeah, certainly a good metric. No metric alone, just like you said, Roland, I agree, is, I guess the key to being a successful investor, because a lot of the pro forma is ex ante, the returns aren't there yet. So you're essentially trying to figure out if they can actually achieve the return. Can they achieve IRR? Which again, it's a good metric. It can be a bit misleading sometimes because of the sensitivity of and the timing of cash flows. So if you get an early distribution, it can boost IRR. And so that may really not reflect the total profitability or the investment's risk profile. So you can look at, discounted cash flow, the cash on cash return, I think is important, which measures the ratio of cash income to the initial investment. And then you express it in an annualized percentage. So I like that. If you're looking at, venture or private equity, they talk about TVPI or DPI, and that potentially could be it. But at the end of the day, right, this is what I'm interested in. What's my multiple on invested capital, or referred to as MOIC? Folks in the business will call it MOIC. I think that's really important. And then how long am I going to hold this money for? Right. And then you try and reverse engineer that, and you start to ask really good questions. And I think where, CAIA helps you think about certain things, ILPA, the Institutional Limited Partners Association, has fantastic deliverables for due diligence questionnaires. And so that helps you ask better questions. And I don't know if you'd ever want to hand a GP the due diligence questionnaire from ILPA. You wouldn't have many friends that are GPs because they'd probably take several weeks to go through. But I think ultimately you can really start to, take some of the great questions that ILPA has in their DDQ 2.0. I think you can download it for free. You don't even need to be a member, and start to ask some really good questions. How are they going to achieve these returns, right? That is a big deal. And anybody can say we're projected for our multifamily ground up development to achieve 25% IRR or a 2.5 MOIC with a 8% cash on cash. Well, how are you going to get there? And I think it's good to step back before the numbers and get to know the people behind it. And that's really important. Who are the folks that are actually putting together the private investment deals? And also, what's their incentive? So a lot of times, folks in the industry will call them hurdle rates or the waterfall. Those types of incentive questions, I think, are really important. And if you can understand incentive and that's aligned, then that's a pretty good start to making an allocation or saying, okay, the GP and the LP have some alignment of interest. And I think depending on, what that sponsor or GP look like, interchangeable, it could look different. Perhaps somebody newer or an emerging manager might have better terms for the LP if it's a fund one, and they start to build their LP base and their track record. They might be willing to give up a little bit more.
Well, so my takeaway from that is multiple on invested capital and the qualitative due diligence and looking at who the manager is are really important. So that's good. I like hearing that response.
Right. Roland had mentioned the Sharpe ratio, and sometimes we talk about it in respect of commercial real estate. Do you think it's that important or relevant? Or it sounds like perhaps what you said before was that those kind of metrics are less useful. You need to deal with the reality of the project in front of you.
Yeah. So interesting when you bring up Sharpe ratio, which we're really talking about return for the risk, right? Higher Sharpe ratio means the return is higher for the level of risk that you're taking. And the challenge with the private markets is data is extremely fragmented. And a lot of the investments, most of the investments are not traded frequently. And so you have this smoothing of returns. In fact, I think, the level of risk is understated in private investments. So a lot of times we feel that private investments, their Sharpe actually looks better, but they're smooth returns because they just don't trade as much. And so naturally, you're not going to see on your statement, if you're investing in a lot of these private investments, you're not going to see markdowns as much. You might see markups because wealth managers get paid on that, and so do the asset managers. So, we'll see about that, just depending on what type of investment is. But yeah, I don't know if Sharpe ratio, is it useful? Sure, if there's enough data points, and depending on the structure of the private investments, you're seeing, these different fund structures that exist that wealth managers are accessing. So perhaps it's useful there if there's enough of a sample set of data.
That's really useful, because I do think, what happens when you start to work in the investment space, especially with a professional like yourself, then it's easy to hear terms thrown around a lot, and people get to feel like they're smart because they're using words that are supposed to have a lot of meaning. But then, as with most things, it comes down to practical application, whether the set of facts in front of you has any relevancy to the words, even if they're, one could say, fancy words like ratios and whatnot. So it's nice to hear from someone as experienced as yourself saying, just, be practical. Don't over rely on what words are out there for different metrics that people use. So.
Well, I had a thought that maybe we take a little detour off the script, because this the solution that you're talking about, Mitch, with the 1031 exchanges, is there any way that you could give us more details about that, how it works?
Yeah, sure. I'll back up a bit. And so ultimately, when I embarked on creating my own firm in net equity, my goal was to actually deliver alpha or above average returns. I didn't know how I was going to do that, but I figured I have really great connections that are GPs, folks that work all over the place, really smart people that I've never been able to work with in my prior capacity as a financial services wholesaler. And so now, as I was building this business out, I tried to figure out where my place was. And as I was syndicating commercial real estate investments, I started to get a lot of requests for 1031. And so as we started to explore the 1031 space, I noticed several particular trends. One, nobody had done any planning for a replacement property, or perhaps it was indicative of the 45-day time horizon. It's a relatively short amount of time to do the due diligence and find a specific property that matches the amount that you have to roll over in your exchange. So sizing and timing is critical. And so we started having a lot of conversations around that. And then I started to understand a few of the other investment vehicles like Delaware statutory trusts, DSTs. And so DSTs are interesting to me in the sense that I think they solve for sizing and they solve for timing, but I look at them perhaps like I would look at a fixed annuity, where I'm not the biggest fan of them. They're, on a relative basis, extremely expensive. They have terrible lockup periods. So you're going to hold this for probably 5 to 7 years. They're expensive. And the rate of return was near the risk-free rate. So why am I doing this? Well, specifically, it's just to avoid taxes. And that's a guarantee. I know what that amount is. So I think for a lot of investors, they're willing to accept a much lower return. When I talk to sophisticated RIAs and other wealth managers in my network, they would tell their clients, just sell it, pay the capital gains, We have far superior investment products that can deliver much better returns than this. And I think that can be a difficult pill to swallow for folks that have built a lot of their net worth on the heels of the exchange and deferring those taxable gains. Because if you think about it, would a wealth manager ever tell you to maybe, sell your, let's pay the taxes for your IRA and roll it over into a Roth? Maybe they might. There might be a certain point. It's not the worst advice I've heard, but I thought to myself, is there a better investment opportunity that we can figure out in the 1031 space? The other thing is I looked at a lot of bad investment deals too, actively. So you think about whether they're duplexes and fourplexes and eightplexes and any other multifamily, leaseback, car wash. There are all, triple net, double net. I've seen them all, but they don't deviate too far from the risk-free rate. They're relatively low yielding returns, preservation of capital, and you're going to hold the asset for quite some time. And in some cases, you might have, some pain in the operational management of owning this asset. So that comes with something to think about as well.
Yeah.
Well, so it's good to understand then that while 1031 can be a solution, a lot of us fall into that trap of when we only have one tool that's a hammer, every problem's a nail. And I like hearing that you consider all the possibilities, and maybe the 1031 is the right solution, but maybe the solution is to sell it and pay the taxes, because we also know what the tax rates are now, but we don't know what they may be in the future, and they may go up. So
yeah, and I usually work through COIs who are primarily wealth managers, perhaps whether they're work for a broker dealer or they're registered through the state and their RIAs or their family office. I typically work directly through those centers of influence and let them dictate how they want to handle that particular scenario. My job is just to provide a more compelling investment solution. And so diving into that, syndicating the commercial real estate, I noticed many of the real estate folks who were merchant builders, and merchant builders going ground up, stabilizing the asset, and then ultimately selling the asset when it's fully stabilized. And so those folks were raising capital for early entitlement process. Think about the horizontal development that goes in, which traditionally takes several, maybe 12, 15, 18, 24 months. Every specific jurisdiction, county, municipality, they have their nuances. And if the developer is really knowledgeable and understands the process, they can do it in a much faster time. But there's so many environmental issues that could come into play and things that could make the hold times a little bit longer. My point is they needed capital for that. And there are places to go. There are private credit, which is just a nicer way of saying hard money these days. Mm-hmm. We've elevated from loan shark to hard money to private credit. We've officially institutionalized loan sharking. But they were really looking for capital without a lot of money down. There is risk involved in throwing that. But also, if you're a merchant builder, the velocity of capital of their own money that they would have to put in could be deployed elsewhere in a project that is a little further down the line. And it really comes down to just economics and velocity of return. And so it really didn't make sense to really have a lot of, I would say, some leverage involved. They wanted as much leverage as they can get. And with banks having issues around lending in this space. I thought that if they're willing to pay private credit like debt rates and investors could benefit from that, let's match the 1031 investor with a developer who is a full merchant builder. And in this case, they own the dirt. The 1031 investor actually owns the dirt, and they set up a right of first refusal lease back. There's so many creative structures, but it's all accrued. So as long as the investor doesn't need any current income, it's a great investment return for accrued returns. And my job in the process, one, is to play matchmaker, and to do the due diligence on the developer. Everything that I talked about around what I've learned from CAIA, the deliverables that ILPA provides for me, I'm able to ask some better questions and ensure that the developer is going to be around, also that the incentive is there. But also from a risk mitigation perspective for that 1031 individual, if you think about it, what is the risk? Well, the risk is the developer walks away from the project. And what does the 1031 investor own? Well, if the developer has a reputation for going full cycle on every project they've done, well, then I can assume that there's perhaps a good likelihood that this developer is going to see this project through. And there is minimal risk. But in the event that the developer perhaps become over-levered, we're seeing it now, and they walk away from a deal, what are we left with? Well, if they made any improvements on that dirt, the 1031 landowner is directly beneficial. And so we have the opportunity to continue getting that dirt entitled, and perhaps they have an opportunity to develop that land themselves, or take it to market. Perhaps they get an offer from somebody else that finds out about the project and they want to take over. And so there are a few outs, and here based in Austin, perhaps it's a game of Texas Hold'em. There are outs that you mitigate your investment risk through the different optionality. So hopefully I've done a good job explaining that, but
I think so.
Yeah, I think so. And if our listeners have more questions and want to get more details from you, we're going to make sure that they've got your contact information to reach out, be able to reach out to you.
Thanks for sharing all that. And just to finish off, did we have any other, I think you did mention qualitative things that you consider within investing, but do you have any other qualitative tools that you like to think about or that you use when you're assessing the quality of an investment?
Yeah, so first I want to assess the quality of the people, and we run into affinity bias quite a bit, where so-and-so knows somebody and they trust them implicitly. And from firsthand experience, I heard the words extensive due diligence, and he's a really good friend of mine and a mentor of somebody that I've known for a long time. And early on in investing, that was really one of the few losses that I've had in private investing, was not actually diving in to all of those components, trusting somebody else's due diligence, which happens even in the institutional space across the board. There's many instances. I think you can look at Madoff. I think you can look at, even in the public securities, Enron. I mean, there's just so many examples that exist through malfeasance of not doing proper oversight. And so when you think about the qualitative aspect, number one is the key personnel. So I'm affiliated with a broker dealer called Finalis. Finalis is essentially my compliance backbone. They make it really easy for folks like me in the private investment space to bring deals to market. And part of what they do is built on the heels of an attorney who also grew up in Boston. And what they've been able to do is provide a good framework around that compliance due diligence. The first and foremost is running a LexisNexis is the program. And so that does a background check on key personnel. That's important, right? And you definitely want to know who you're dealing with. If there's ever been any, bankruptcies or criminal activities, those are things I want to know of and things I want to stay clear of if they're, made aware. So I think that's the most important thing, but also, finding out their service providers. Who do they do business with? And asking them to provide referrals with other LPs and finding out, getting to talk to those LPs, asking those LPs if they know anybody else who knows that particular GP or sponsor. And asking questions is the best part about due diligence, and not having the experience, you're not going to know what to ask, right? So I ask questions all the time. And I would also say, invest in what you know. If I go back to how I got started in this business, in the 6th grade, the Boston Globe had what's called the stock market game, where they give a group of young 12-year-olds $100,000 in virtual currency, and you would invest it. And the winner, I forgot what they would get, but bragging rights. I actually won that. I was terrible at school. I could care less about math, history, or anything, but that was the greatest influence on me. And the way that we won it, if you give a 12-year-old $100,000 in fake money and tell them to go buy stocks, what do you think they would buy? So Hershey, we bought Disney, we bought Coca-Cola. I mean, it was the most 12-year-old investment portfolio, and somehow we won. And my mom still displays my Boston Globe stock market certificate as probably my proudest academic accomplishment, in my formative years. But invest in what you know. And so, here in Austin, there's a lot of venture, and venture's really cool and it's really appealing. And you know what else is really cool and really appealing that has less risk? A roulette table. You could go to Vegas and put your money on a number on a roulette wheel and have a higher by percentage of success of getting a 30x return than venture. Those are true statistics.
Yeah.
I'll have a conversation with anybody. And so if you're going to invest in venture or private equity, I think you ought to know about the business, and you ought to be able to help that business and be strategic and not just be passive. Otherwise, if you don't, you better find somebody that understands the space. And that's what I do. If I don't understand a particular space, which I see so many deals, I reach out to people in my network that might have experience, or if they've seen something like this, and you start to understand it a little bit more. But you got to ask really good questions. And if you want better outcomes, you got to ask better questions.
That's a great principle.
That's a great key takeaway for us here, I think. Do you want to, shall we shift over? I really enjoyed your story about the investing in Coca-Cola and Atari or whatever. I don't know if you could invest in Atari, but we were going to discuss just, moving away from all of this, just what your views were on certain things. And Roland, do you want to move on to that?
Yeah. And Mitch, just giving you an opportunity to look into your crystal ball and share your perspective on where the markets are and where they're headed, just talking about anything that you want to, that you think has the most relevance, and, how you track the broad financial markets.
Yeah. Well, I'm an amateur prognosticator, and not a good one. So I've been, I guess, quite surprised on where the public equity markets are today. I don't know how you can cut your way into growth, but I guess when you're a technology company and you don't need people as much because you're leveraging technology, you can continue to enhance those profits by cutting personnel. So I don't know. I'm a bit cautious, and I'm not sure if I'm the right person. But I see consumer spending has gone down quite a bit. You look at credit card balances going up quite a bit. You look at how much better can employment get. I've got to think it's going to swing the other way. And we're starting to see little cracks of that here and there. It's a really funny place to be. I think as my crystal ball would say, if I'm making investments, more importantly, it gets back to what are my goals, right? And timing any market is really difficult. But if I've got long-term goals with great investment, great, GPs, and I'm okay with that, it doesn't really matter what so much the market's going to do what the market's going to do. And I think it just comes down to how much, risk you're willing to accept. But yeah, I'm terrible at market predictions, and so I don't know if I'd be somebody good there, but I'm cautious right now. That's for sure. Just in general of the macro and things that I'm seeing, I feel like the consumer is tipping, and you're starting to see inventory in real estate where most people's wealth is tied up. Those are coming to market, and perhaps we've had this Gulliver on inventory because folks have really cheap debt. If they want to trade up or trade down in their single family home or condo, whatever their personal residence might be, how do you trade out of 2 or 3% or even low 4% paper? Your mortgage has almost become an asset in itself. But if people lose their jobs, and naturally you have life events, whether it's divorce or whether addition or subtraction, I'll put it there, and eventually you're going to trade up or trade down. You just have to do it. But we're starting to see more inventory specifically here. And I think I saw a recent article in the Wall Street Journal that we're on track for the worst home sales year since 1995. So that's 30 years.
Wow.
So yeah, I don't know. I don't know where, if real estate is a big proponent of folks' wealth, I could see folks' wealth being diminished, and overall the consumer being in a tighter position. So that's scary in certain instances. And so inflation, you see gold at a high. I think that might be somewhat indicative of at least where my thoughts are. It's a flight to quality. Anytime you go through these downturns in the economic cycle, it's always a flight to quality.
Yeah. Yeah.
Well, that's great. And I appreciate your honesty there.
Shall we move on to your other project? So we've talked about, all of this that's obviously relevant for AIM, and also just generally very interesting about you, Mitch. But one thing we haven't talked about yet is that you have a non-investment manager podcast that you produce, or you present, I should say. I'd love to hear more about that.
Yeah. So years ago, as somebody who is an absolute fanatic in sports, I love the overall Las Vegas sports betting market. And years ago, it might have been 2015 or 2016, I was reading an article about a private equity analyst winning one of these NFL contests where you've got to pick certain games each week, and whoever has the best record at the end of the NFL season would win a nice amount. It's like $1 million. And so I started to play around with numbers. And at that point, I was just, a financial service salesperson. Again, amateur analyst, didn't have any designation, didn't have my CAIA, had no formative training of doing any type of analysis, and math hurt my head. So it was not of interest. And so I started playing around with numbers, and I said, well, if the Las Vegas betting markets obviously come up or set a specific point spread, well, there's a formula involved, and perhaps there's a way that I can apply investment principles to the Las Vegas betting markets. And over the years, I think this is year 9 now, we have we built a linear regression model. So I was doing this by hand for quite a bit, which would take me 2 hours a week to do. And we applied all those metrics into a linear regression model, which isn't an algorithm, but people use, algos and AI as something that sounds smarter than it is. But this is, in full disclosure, this is linear regression, and we just try and find correlating metrics that give us some value in the betting markets. And so the podcast that we have is affiliated with a group called Roster Watch. And they've got a YouTube page there where I join on Wednesday, and we debate what goes in to the Circus Sports Millions contest, where the winner gets $1 million, and we discuss NFL, and I talk about data points and what the model actually predicts. So it's relatively pretty good. And we've been having some success for quite some time. And then I'll go on Sirius XM channel 87, 4:30 Central Time every Saturday, and talk about some of the model predictions.
That's really
That's
cool.
great. Yeah.
Have you ever looked at the UK markets in respect of rugby?
No, but I played rugby.
That was what you said earlier. So.
Yeah, but no, and I don't know anything about it, and I don't have the data points around any of it. So remember, invest in what you know, and I don't know that.
That's true. No, I don't know anything about it. I just know a lot of people that played or play rugby still, which I still find striking because it just looks so dangerous. But I know it's extremely enjoyable when you're good at it. That's what I've heard from people who grew up playing rugby that I've known over the years. So what do you think, Roland? Shall we wrap it up at that?
Yeah, that seems like a pretty natural place to stop. And everyone, by the end of this episode, we hope that you've had a chance to learn more about Mitch and how he thinks about alternative assets. This has also been an advertisement for the Chartered Alternative Investment Analyst designation that Mitch holds. I really respect that. It's like a graduate degree in investment management, finance. So Mitch kind of understated how hard it is to get that designation. Everybody that I've ever known that's had that has been extremely talented, extremely intelligent people. I've really appreciated their perspective on the markets and investing. So I guess, Mitch, before we do our outro, just let us know how our audience can get in touch with you and find out more about your investment opportunities or the regression model podcast. You mentioned Sirius FM channel 86.
Sirius XM 87. Yeah.
87, sorry.
They've got a show from 3 to 5 every Saturday. And I join on the latter half of that at 4:30 Central Time. So it's always fun, and have a good time doing it. And it's a fun hobby. But if you want to reach out, just reach out on LinkedIn.
Okay, we'll make sure that we include some links in the notes of this episode.
Yeah. Thanks so much, Mitch. It's really nice to meet you face to face this time, I should say. So to our audience, thanks for watching. We hope you enjoyed this episode of Alt Investing Made Easy. If you did, please like and subscribe.
Remember, everyone, take aim with your alternative investing strategies.
And we'll see you next time.